All right, so as Andy gets set up, just a few housekeeping items for everyone. This is the ESG and Focus session hosted by Element Markets. You've got David Moore, I'm the associate on our carbon team speaking, and Andy Brosnan, our director of strategy, who will be leading the session. Andy, were you able to get your audio up and running?
Yeah, I think so.
All right, awesome. So yeah, I think now at this stage, if you want to go ahead and share your screen, and for the folks who have joined the session, the way we've structured it is I will be giving a brief intro of the company, our renewable natural gas desk, the carbon team, and then I'll be passing off to Andy to manage the core topic of the session, so ESG and Focus. How do offsets in renewable natural gas play a role in voluntary sustainability initiatives? So Andy, I'm not sure if you're able to share your screen or share the slides.
I just tried, but didn't have success. Let me try again.
And I think for everyone's benefit, this new platform has been a little bit wonky. I'm sure some of the other sessions have been similar, but we'll go ahead and see if we can manage this. Okay, yeah, here we go. All right. And for everyone's benefit, we will be doing a probably 15-minute Q&A. So after I pass off to Andy, I'll be collecting any questions, and then we'll circle back after the presentation to address any specific question that folks have. So just a refresher, David Moore, I'm the associate on our company's carbon team, and you've got Andy Brosnan here as well. He's our director of strategy. And just some information about Element Markets. So our company was founded in 2005. We've since grown to become one of the largest independent environmental commodities providers in North America. So we're a large player in the renewable natural gas space, carbon offsets, and we also have teams focused on several other business lines, including emission reduction credits, renewables, and low carbon fuel standard credits out on the West Coast. Some big news that some of you may have seen, our company, a majority stake was acquired by TPG's RISE fund, which is a global impact investment fund. And so we're really excited about these new opportunities. All right. Some information regarding the renewable natural gas team. So our company is a large independent marketer of renewable natural gas. We represent around 20% of all RNG that flows through the U.S. And Andy will go over the definition of RNG in more detail. But essentially, we provide a turnkey service for monetizing renewable natural gas under the Renewable Fuel Standard and other programs. And then the carbon slide here, which the realm that I'm most familiar with working on the carbon desk. So a little bit of background about the Element Markets carbon team. So we're active in both voluntary and compliance greenhouse gas markets, both North America and globally. We maintain a portfolio of offsets from over 40 plus projects, both in the US and internationally. And we've transacted over 50 million credits, and we can help optimize those credit uses for voluntary sustainability initiatives, compliance programs, as well as cross commodities focus. So you see on that bottom slide, RECs, RNG, LCFS credits, etc. So with that, I think a few other key points. Andy and I are both located here in Houston, Texas, which is where our company's headquartered. But we do have offices out in Carlsbad, California, remote offices in New York, and Budapest, Hungary. So with that, I'd like to introduce our speaker, Andy. who's our director of strategy. He spends a lot of time focused on this interplay between renewable natural gas for voluntary uses, which is an increasingly interesting topic these days, as well as bundling that product with carbon offsets and how that fits into your sustainability strategy. So with that, I will step aside, let Andy take over for the presentation, and I will be collecting questions as they come. Thank you.
Thanks, David, and thanks to everyone for joining. I apologize for the hiccup at the beginning and getting on, but it seems like we have everything straightened out. So I thought a good place to start would be to kind of level set on the definition of ESG and ESG investing. I think all of us know kind of the E, S, and G stands for environmental, social, and governance, but we kind of infrequently look excuse me, at some of the subcategories associated with each of these buckets. And today we'll focus on the environmental side and specifically on the greenhouse gas emissions. But I thought it'd be helpful just to kind of see the subcategories of social, governance, and environmental as a starting point. And in terms of just understanding as a definition, you know, ESG as a way of investing is simply, instead of the traditional, or perhaps in conjunction with the traditional view of investing in which you're trying to maximize your return on capital, you're also looking at these other three factors, environmental, social, and governance. And you're basing your decision on whether or not to invest on how well a company scores in each of these categories. And this term ESG integration simply talks about how you take this approach coupled with the shorter term kind of traditional stock analysis approach to get a holistic view of the company, in which you're weighing how well a company can generate capital and return on your capital, and then how well they score in these three categories. Again, focusing on the environmental today. And so with that definition, kind of the next question is, you know, why has it become so important for both companies and investors? So if you think about it from the company standpoint, scoring well in each of these categories is going to allow you to attract talent. I assume, you know, most folks on the call, when making their choice on where to work, looked at both the salary that they'd be paid, but then also whether or not the values of that company matched their own. And so, you know, scoring well in these metrics allows you to attract talent. Secondly, you know, customers are seeing more and more customers, we're seeing more and more customers being willing to pay a premium for, in the environmental space, green products. So a decade ago, there was a lot of talk about them. There was definitely a preference for them, but more and more we're seeing people willing to pay money or a higher premium for them. And then just the ability to attract capital. So as the BlackRocks of the world push ESG investing and push companies to be more transparent in each of these categories, a company's ability to attract capital from BlackRock and others will depend on how well they score. So there's an incentive for companies to start, again, tracking their metrics in each of these categories and disclosing them. From the investor perspective, you know, it's kind of twofold. One, there's data out there that suggests that companies that score well in these three categories are also having higher returns. And that makes sense because these three categories look at kind of longer term strategic growth and not just the quarterly reporting. Second, in terms of risk mitigation, and you can think of, you know, for example, the incident that happened here in Texas in February, in which many power providers, due to extreme weather, went under, were not able to provide service, defaulted on contracts, and went bankrupt. So knowing in advance that that company was not prepared for an extreme event like this would help the investor know that there's a high risk associated with that particular power provider, and help him gauge his decisions on how to allocate capital and hedge against risk. So as we get into the discussion, I think it's helpful to understand kind of the evolution of ESG investing, where it started, where it might go, and then we'll kind of come back to where it is today. So where it started, it was very much a mindset of divesting as opposed to investing. And so if a company was a large emitter, then ESG investing, or SRI, social responsibility investing, simply meant I would choose not to invest, or if I was invested, I'd divest from that company. Where it might go tomorrow could be something much more nuanced. So if you think about climate science and climate modeling today, scientists can look at a 150 square kilometer region and do some climate modeling to understand the temperature rise in that particular region and how that will impact the global temperature. It's not an exact science, but certainly exact enough to be able to make some of these predictions that we're making on climate change. But what it can't do is say within that 150 square mile box, tell whether or not a particular asset is at risk to, let's say, extreme weather events, or a particular farm might suffer from a heavy rainfall just before harvest. We don't have that type of nuanced data or technology that will get us that data. And so therefore, we're not able to make good assessments on risks associated with a particular asset. But we could get there, but climate modeling and climate science will need to improve. So without having that crystal clear picture of a potential climate risk to a physical asset, we have today kind of a blurry picture. And instead of risks to specific assets, there's a focus on risk associated with perhaps government regulation and whether or not a company would be exposed if, in fact, governments came together to help regulate emissions in a way that would have a financial impact on a particular company. So today, the frameworks that are out there to help companies assess how they fall on this environmental bucket of ESG are many. And if you see in the graph here, the basis for CDP disclosure, SASB, TCFD, and the Science-Based Target Initiative is the Greenhouse Gas Protocol, developed in concert with many organizations by the World Resources Institute. And the Greenhouse Gas Protocol is the basis for the reporting that companies do in the ESG space. And so we'll spend a little bit more time understanding the way that protocol has broken down emissions into the three types: scope 1, 2, and 3. But before we get there, as a company looking to be able to report these types of ESG metrics to investors, there is this kind of 5-step process. The first step is understanding what your carbon footprint is, right? Quantifying it. Once you have a good understanding whether it's scope 1, 2, or 3, you can make a plan to address those emissions. And this is where you start to see more and more net zero pledges from companies. And they understand their footprint and they create a plan to get them from where they are to where they want to be. The third step is reductions. So whenever cost effective, reducing footprints, whether it be by changing out technology, switching suppliers, or introducing a new type of energy product, such as RNG, is the preference over offsetting. But we know it's not always cost effective or even physically possible to reduce, at which point offsetting becomes an important part of achieving your goals. And then the last step in the process is reporting. So you've quantified, you've made a plan, start reducing, offset what you can't reduce, and then report on progress so that investors in the ESG space can understand where you fall relative to others in your industry against these metrics. So again, coming back to the Ghg protocol, which is the basis for some of these ESG metrics, it's important to note and understand each of the 3 types of emissions. So Scope 1 emissions are emissions from owned and operated sources. So these are your gas boilers, the natural gas that you burn at your facility. It is a Scope 1 emission. Scope 2 emissions is emissions from, let's say, procured electricity. And it's Scope 2 because when you're procuring electricity from the grid, you can't actually control the makeup of that grid. It could be partly generated by coal, could be partly generated by wind. You don't know that makeup, and so therefore it's in a separate category, Scope 2. Scope 3 is kind of the entire value chain, your upstream emissions from your suppliers and your downstream emissions from your customers, as well as any business travel, employee commutes, and things of that nature. Now, there are different tools to address each of these scopes. You can see carbon offsets applied to both Scope 1 and Scope 3. RECs have become a well-established market in reducing companies' Scope 2 emissions. And we're just now starting to see renewable natural gas become an option for customers who want to reduce their Scope 1 thermal emissions. So talking about renewable natural gas and how it might be able to play this role in reducing companies' Scope 1 thermal emissions. First, just starting with kind of an overview of the natural gas or renewable natural gas landscape. There are really 4 types. RNG derived from landfill, from wastewater treatment facilities, RNG from anaerobic digestion, typically from swine and dairy manure, and then lastly, food waste. In the voluntary markets, most often what you'll see is landfill gas, wastewater treatment facility gas, or food waste gas. And that's a product of the opportunity costs for a producer to send their gas into the transportation fuel markets. And we'll talk about that in just a minute. But all of the gas, no matter where it comes from, is purified, upgraded, and pipeline injected into the common carrier system and can be withdrawn at any point of connection to that common carrier system and used to reduce the company's Scope 1 thermal emissions. So some of the benefits of RNG outside of just greenhouse gas emission reductions are, improved waste management, right? It's absolutely clear that animals, humans will continue to produce waste. Let's do something useful and productive with it. But you also have added benefits of improved water quality and air quality from consolidating this manure, keeping it out of the water streams, and then again, making a more productive use out of it, and energy resilience, because all of this waste is right here at home and oftentimes can directly supply companies who have facilities on site. Now, getting gas to the voluntary markets, it has been a bit of a challenge. And the primary challenge is the price of that gas relative to brown gas, what customers are consuming now in the status quo. So if brown gas or fossil fuel derived natural gas is $3 a decatherm, gas that's renewable can range from $30 to $120 per decatherm. And the reason for that is primarily the opportunity cost for the for the producer. So from the producer's perspective, he has 2 options to sell his renewable natural gas. There are 2 options in which to sell renewable natural gas. The first and most common is the transportation fuel market. And the transportation fuel market is really two markets. The first is the Renewable Fuel Standard, which is a national market that deals with RINs on a RIN basis. Natural gas, renewable natural gas generates a RIN, which is right now about $3. And there's a EPA multiplier on that gas of 11.727. So which puts the total value of that gas in the transportation fuel market at around $35. You have marketing fees and tolling fees, which takes around 15% of that off. And so it's $30 in the market from 35 to 30. But gas that can also be stacked and used and sold into the LCFS market, which is the second transportation fuel market, and that is a carbon intensity driven fuel market specific to California. And so the same molecule of gas can get sold into both of these markets. The graph that you see here is the value of a particular type of gas, the swine manure gas. And because swine manure gas has a lower carbon intensity than landfill gas, it fetches a higher premium in the LCFS market. And in fact, if you look at the life cycle carbon intensity scores of each of the gas types, swine manure is about a -400, dairy is about a -250, landfill is at a +30, 45, wastewater treatment about the same, and food waste ranges from -50 to 50. But that carbon intensity, again, because the LCFS is a carbon intensity based system, drives additional value. And so for swine gas that's produced, you have the two markets, and you see the RIN market that I just talked through at about $30. On top of that, in the graph, you see the LCFS value. And that brings the total price of that gas up to about $110 per MMBTU. So from the voluntary space, I would have to compete with that market for the producer to redirect that gas away from the transportation fuel market to sell it to me. Which, again, that just doesn't make a whole lot of sense. And so typically you're not seeing the swine and dairy go into the voluntary markets. Instead, you're seeing the landfill gas go into the voluntary markets. And this is primarily because now landfill gas, because more and more dairy and swine is coming online, a lot of landfill gas is getting pushed out of California and is only in the RIN market. So from the perspective of the producer, they're weighing, can I put it into the transportation fuel market, which is right now at $30, but it's volatile. It's not always going to stay at 30. Could be 25, could be 20, could be 35. Or should I sell it at a fixed price to a voluntary buyer who will allow me to hedge some of that risk in the transportation fuel market? Now, many producers are doing a combination of both. They'll have a project of which a portion of it will go into the transportation fuel market, and then a portion of it they'll sell into the voluntary space at a fixed price. But that's what the voluntary market is up against. They're up against the opportunity cost of that producer selling the gas into the transportation fuel market. So it is a challenge to bring that price point down and to find a deal that works. But again, because you're hedging some of that risk, it is possible. So in the voluntary space, there's a few important points that have developed in really the last year or so. And that's first on the tracking side. And MRETS is a system that's established in the REC space, but just recently moved into the renewable fuel space with the creation of renewable fuel certificates that function much like a REC, in that when RNG is produced, and injected into the pipeline. In order to avoid any double counting of that molecule and the environmental attributes associated with that molecule, MRETS gives it a serial number that as it moves through the pipeline and is traded and transacted, that serial number stays with that molecule. And then when it is finally consumed, it's retired on this database so that anyone that buys renewable natural gas and uses the system has kind of third-party verification that no one else has. And this will satisfy that ESG investor that's looking for concrete evidence of the company's Scope 1 thermal reductions. The second kind of development is this Greeny renewable fuels program. And at the moment, it's still in draft form, but much like the REC market that Greeny has again, is well established, a similar standard will be created for renewable fuels. So Greeny will look at things regarding the types of feedstocks, the production methods, the transportation of that feedstock, will force disclosure on carbon intensity or allow it, the project location. All these things will be in a certification that will allow, again, more confidence of that buyer in the voluntary market to be able to say that the gas is responsibly sourced and meets a certain certification threshold. So again, just to recap before getting into carbon offsets, renewable natural gas is a great tool to reduce Scope 1 thermal emissions. Right now, the problem or the obstacle to overcome is the opportunity cost that producers can get when selling that gas into the transportation fuel market. So the high price is really the primary obstacle of the RNG reaching the voluntary markets. So one way to get around this is to use carbon offsets for at least a portion of that natural gas to offset the emissions of that natural gas footprint. So, you might take a portion of RNG to displace a portion of your natural gas consumption and use offsets for the remainder of it. And offsets, as most folks know on this call, but to go over a brief overview, come in a variety of project types. We have 5 listed here, but each of these, no matter where they're derived and how they're derived, is the equivalent of 1 metric ton of CO2 emitted. And they all hold these same characteristics that I've listed here on the left-hand side. So they all have to have a permanent reduction. The reduction has to be additional. It can't be required by any legislative body, or it can't be business as usual. And they have to be verified by a third party to ensure that the reduction is occurring as described. Enforceable, meaning there can't be double ownership of that particular offset, and real, in that the emission reduction can be accurately measured. So these offsets trade and track and are retired on one of 3 carbon registries here in the US, ACR, Climate Action Reserve, and Verra. And when a customer looks at how to select which offset is best for them, like RNG, there's kind of a few variables that they consider. The first is price. Offsets range anywhere from $4 to $12 in the US. The second is story, right? I mean, if you are wanting to reduce your emissions, being able to match that reduction in a project type that makes sense, that's important. And on top of that, location is often important for customers. Being able to provide, for example, jobs at a nearby project often resonates with customers. Co-benefits associated with that project, jobs is one of them, but there are several others that, for example, the emission reductions from forestry have wildlife and habitat benefits. And then other considerations are the vintage, when the offset actually was minted and created, the ability to remarket, particularly if for a business carbon were ever to be regulated. So thinking about whether or not it would apply in a system like that. So as companies look at the ESG investment landscape, as they zero in on the E of that ESG and think about ways to reduce their Scope 1 thermal emissions, it's important to keep these two tools in mind. RNG, which allows for a direct reduction of their top line Scope 1 thermal emissions, and carbon offsets, which when RNG is cost prohibitive or can only be used for a portion of meeting your goals, the offsets kind of fills that gap. So I think with there, I'll wrap it up and just leave the rest of the time for any Q&A that's come up.
Thank you, Andy. And I appreciate that quick run through. Just looking at our audience, just to summarize, I think there's a lot of ways to slice this. And, some people in the audience may be thinking, well, I have a RNG project that I'm looking to develop. How can I go about financing? What are the next steps for North American markets? Other groups may be looking at it more from a buyer or procurement perspective, saying, well, I'm in charge of managing a ESG portfolio or setting new sustainability targets within our organization. So from all of these aspects, we're always happy to engage and have that conversation, both on the RNG side and on the carbon offsets team. And then certainly wanted to iterate, looking through the attendees, lots of familiar faces. So just want to drop a line and say hello. And I know it's been an unusual year or greater than a year, and we're all looking forward to some return to normalcy here. So hopefully we can have these discussions in conferences in person in future years. So only had a few questions. I think, Andy, there's one related to RNG, I think getting at, how does that value stack work out for swine gas? So would you please explain why RNG from swine is worth more than that from the landfill? And so I think the question is kind of getting to that carbon intensity score.
Yeah, sorry, I perhaps skipped over that in my discussion of those two slides. But again, there's two transportation fuel markets. The first is the RFS, and in that market, whether the gas is derived from swine, dairy, landfill, or food waste, well, not food waste, sorry, but those first three, the value is the same. It's a D3 RIN that sells regardless of the carbon intensity of the RNG. The second market, which again can be stacked on top of the first, is the California Low Carbon Fuel Standard, and it uses a carbon intensity metric to value the gas that's coming in to the state of California. So the lower the carbon intensity, the more credits that can be created, and therefore the higher value of that gas. So swine is, if you look at the life cycle emissions, is about a negative 400 carbon intensity, whereas landfill is at a plus 30 or 40 carbon intensity. So because of that negative carbon intensity score, it fetches more value in the LCFS market. And when stacked with the RIN, it creates more value for the producer than just the landfill, based on that lower carbon intensity.
Thanks, Andy. We've got another question. What opportunities do you see to use blockchain for offsets verifiability and enforceability? And I'm happy to take that one. I feel like I'm kind of the resident blockchain enthusiast at our company. Really involved in tracking the developments both on public blockchains as well as private. I think in general, there's certainly as public blockchains and other groups look to tackle kind of these scaling issues when it comes to decentralization. There will be more applications, particularly in the commodity space and carbon offset space. But I think fundamentally, when you think about the Climate Action Reserve and the role that they play, particularly in managing the credit issuance and verification process, you're still going to fundamentally have, right, that offset verification requirement in tracking. And we've got another question from Russell. Let's see here. Can you comment on how emerging regulated / compliance emissions markets could impact the voluntary offset market? And I'm happy to take that one as well as the lead on the carbon desk. So certainly there's an interplay, right, between voluntary carbon offsets, so offsets that may not necessarily fall into a compliance regime, and then compliance offsets. So if we zoom in on North America, we're talking about the California cap and trade market in particular, as well as some fraction of I believe there's one project in the Regional Greenhouse Gas Initiative in the Northeast. As new compliance mandates are set, they tend to, one, borrow off of the current regulations and current programs in place. So, you think about expansion of AB 32 or cap and trade across other states outside of the California, in the West Coast and in Canada. And then Regional Greenhouse Gas Initiative in the Northeast. Certainly, it would honestly just depend on the compliance regime that's put into place and the stipulations that they add. So, we've seen, project list date or start date for Corsia Vintage 2016 plus, and other emphasis in different programs. We've got another question from John. If I am a voluntary buyer with an ESG / decarbonization goal, how should I navigate and select environmental products like RNG and offsets for my scope of emissions? So how do I convey and justify these products to my stakeholders, whether that be investors or senior leadership?
Yeah, so the difference between the two products will illustrate itself in the reporting of emission reductions. So RNG has an advantage over carbon offsets in that it allows you to reduce that top line number of scope 1 thermal emissions. So, and I think I forgot to mention this, but I mentioned at the beginning that all of the SASB, the CDP, they all kind of hinge on the Ghg Protocol. And that protocol says that emissions from biogenic sources, like landfill gas, are reported separate from the scopes. So in that sense, any RNG that I bring into the pipeline, the emissions from that RNG is going to be reported separately. And by reporting it separately, my top line number of emissions goes down. And so you'll see that as a tangible reduction in emissions from natural gas consumption. The offsets then can be used to further reduce that number down to zero, but the actual reporting number needs to be reported. So again, in the eyes of the ESG investor looking to kind of rack and stack how companies are achieving their goals, they are going to favor the company that goes that extra mile or pays that extra expense to displace natural gas with RNG and bring that top line number down. But also we'll be appreciative of seeing an effort to then go further and reduce that to zero through carbon offsets.
Those are great points, Andy. And one comment I wanted to add here is as ESG and sustainability becomes a greater core focus within corporations and other groups, I saw some link the other day of these sustainability program managers are having to move at a lightning speed, getting up to speed on all the different nuances to CDP reporting, SBTI, the different guidance that's out there. So what I would say is if you're navigating these questions internally and thinking about, how do I manage this process? We're always here to serve as a sounding board and provide additional information as needed. And so with that, I think that comes close to wrapping up the session. If there's not any additional questions, I did drop our email addresses into the chat box in case you want to send any more follow-up. We're happy to take things offline and explore different opportunities that you all may have available. All right, so I don't see any more questions in the box. Would like to wrap things up. Thank you for your time, Andy. Really enjoyed the presentation, and I hope everyone had some take-home points and messages that they can chew on as they move forward in this conference.